Okay, so good morning, everyone. Welcome to the new week and the macro snapshot. We are Monday, March the 3rd, 2025, recording this about 7:30 in the morning. Okay, so we had some interesting news over the weekend. Obviously, I think probably most people saw what happened in the White House with Zelensky. There was some risk of this idea that that America was walking away from the North Atlantic Treaty Organization, the Mid-Atlantic Alliance. So therefore, there was a bit of a risk-off tone. But what was interesting over the weekend, there was sort of an emergency meeting convened in London at Lancaster House by the British Prime Minister. And that seems to have given the market a little bit of confidence that actually Europe, this has been a wake-up call for Europe, and that there will be some substantial action on unification of Europe's response to Russia, and specifically increased defense spending. We don't have the numbers yet, but there's all kinds of numbers flying around. And for example, the new German government, which actually hasn't been formed, but let's say the putative new German government talking about maybe 400 billion euros for infrastructure, 400 billion euros for defense, maybe some kind of common defense fund. Point is, it looks as though in Europe there is going to be a definite ramp up, an increase in defense spending up to 2, 3, 4% of each country's sort of GDP, led by probably so the UK, maybe Germany, to a certain extent France and Italy, peacekeepers. So just in terms of the market, the market, instead of being a little bit risk off, if we just look at some of the European assets, we've seen the euro versus the US dollar have a pretty strong overnight performance here. We can have a look here. So you see the euro here going up. Based on this idea that, there's got to be better for sort of infrastructure, sort of fiscal. And the big picture here is that Europe, it seems to be dawning on them that really to compete in this new multipolar world without maybe too much US support, they really have to start investing in infrastructure, in artificial intelligence, defense, we just mentioned, but essentially sort of open up the fiscal floodgates a little bit and actually start to stimulate the economy and spend more fiscally. In countries like Germany, which we won't get into, it could be complicated with their debt break and sort of, sort of negotiations internally in their politics. But the bottom line is that over Europe, there does seem to be a recognition that more fiscal spending is required, and that ultimately is stimulatory in theory. A lot can go wrong. What could go wrong? Maybe there will be no sort of a peace deal in the Ukraine. Things are going to get messy. There's also the threat of tariffs, which we'll get to in a second. Of course, the big threat of tariffs on the EU. And also sort of internal political squabbles and intra-country kind of squabbles. But what we can see this morning is that the euro is up, as you can see here, about 88 basis points. What's going to be very interesting here, these are sort of the simple moving averages coming up, to let's say like the 100-day simple moving average here. And also this, what's been a very tough resistance here at 105.30. Personally, I still think that, that's an interesting short level if we do get up there, 105.30, 105.50, that kind of zone there, just because there is still no internal deal on spending, on infrastructure, and we know how complicated Europe is actually to sort of have agreements. There's also the possibility, the very real possibility, that the war in Ukraine actually drags on and there's not a quick resolution. There's also the possibility that Trump does impose, who knows, 5, 10, 15, 20, 25% tariffs, which would be a negative. So I just still think the market is going to be reluctant to push the euro higher. Certainly, I think this level up here, 106, could be some kind of sort of uppermost limit. So that could be an interesting one there to look at that. The other interesting thing is that with all this talk about sort of fiscal stimulus and spending on defense, of course, that money has to come from somewhere. You guessed it, it's going to come probably from more debt issuance. And then the bond market's not liking that at all if we actually start looking at some of the main. So if we look at the Italian, the French bonds here, we can see on the price, the 10-year is down. We can also see on the Italian bonds that they're also down. But the point is, the big one here is Germany. You see the Bund here really sort of down 113 ticks here. You can see the Buchsel, which is the 30-year, even more so. A lot of this bond issuance, of course, will be issued in the 10 and the 30-year tenor, so much sort of longer term. And the long-term bonds here not liking this at all. And we can see that if we look at, let's say, the German yield curve here. Let's look at, let's say, the 230s. You can see that's continued to bear steepen. So it's going to keep on steepening up until, well, unless they don't do this issuance, because at this point the market is pricing in that there's got to be a lot of debt issuance. And just to give a context here, it looks like these levels up here, we've got maybe another 5 or 6 basis points to go before we start getting some kind of resistance. But definitely the sort of overnight sort of feeling is that whoops, sorry, just trying to clear this here, is that there will be a significant new bond issuance, mainly in, as I said, the longer end of the term, and a lot of that coming out of Germany. Now, we're also seeing that in some of the differentials. So if we look here at the differentials between the American yields and the German yields, which I'll bring up here. I think I've got that here. So let's say the US 10-year subtract the German 10-year. And you can see here that that's actually coming in favor of the German one when, say, getting closer to the US 10-year. So at one point, going back to basically Christmas, there was about 230 basis points between the US 10-year and the German 10-year. But as you guys can see here, down to about 1.75. So that's come in about, what's that, 70, 80 basis points here. It is getting to some horizontal resistance, which you can see here. There's quite a big level down about 173, 174, so another basis point or two. But that's come down quite a lot overnight in the European session. Now, well, before I say now, let's have some tea. Earl Grey this morning. So ordinarily, this, of course, would be beneficial to the euro over the US dollar in the sense that as those differentials are getting closer, it makes less sense, sort of theoretically anyway, to be holding US dollars versus euro. So if we then look at the euro, we can see that, of course, that had gone up. So what's going to be interesting, though, as I say, could coincide if this differential gets down another 3 or 4 basis points. If we look at, let's say, the 5-year differential, well, that looks as though it has a little bit more to go. And we look at the 2-year, that looks like it has a little bit more to go. But I think as most of the debt in Europe and Germany is probably going to be on the 10 to 30 year, I think the one we should be looking at is most probably the 10 and the 30. And let's look at the 30. The 30 also has come down a lot. And as you guys can see here, sort of some kind of horizontal resistance here. Which we can sort of put there. So we are getting to zones where potentially that could reach some kind of resistance in terms of the differentials. And that would imply that maybe that's enough at this point for the euro to have gone up, which would coincide with that 105.30, 105.50 kind of level. So interesting to see what happens today if that continues. But I think we might get a little bit more movement up in the euro, a little bit more of a closing of the spreads. And then we might get some stabilization. In terms of the stocks, one of the main narratives going around the markets here is that it's going to be very bullish for EU, so European sort of equities, especially obviously defense stocks. But if they're going to do, like talking about 400 billion euro fund for infrastructure in general. So we're seeing here, if we look at the euro stocks, if I can find it, where's my euro stock? Yeah. So if you look at the German, the DAX, big green candle overnight, and you look at the Euro Stocks 50, a big green candle. So that looks as though that had been sort of fairly weak price action, but that looks as though that double top retest is now turning into a triple top. We might even have, do we have a new high? It looks as though we did touch a new high overnight. Now, of course, that's great, and that is causing sort of a bullish sentiment. But of course, today is also tariff day for certain countries, which we'll get to a second. But just keep in mind with all of these European sort of, the equities and the bonds and everything, and the euro, that of course Trump, is still talking about early April for a potential imposition of tariffs on the European markets, which would be a negative for the euro stocks and probably for the euro as well, and because it'd be a negative for growth. So at the moment, everyone seems to be very happy, but let's just keep on looking at geopolitics, because at this point, this is sort of the honeymoon period where everyone's sort of shaken hands at Lancaster House yesterday. Everyone's agreed that we're going to do a lot of work. But at this point, in Germany, there still needs to be agreement amongst the incoming coalition. We don't even have a coalition, but in theory, there needs to be some agreement. France has a lot of doesn't have much fiscal space. Italy doesn't have much fiscal space. There's a threat of tariffs. And of course, Ukraine, Zelensky, Putin, there's a lot of unknowns just on the battlefield and the diplomatic front there. So I'm not convinced this is necessarily going to push through and keep on going. We shall see. And let's just keep on looking at headlines today. So in terms of other stuff, and getting a bit back to the US, I think the big picture, kind of interesting. I mean, let's just look at a couple of the ratios which I like to look at. So if we look at the totality of stocks over bonds, so it's like ITOT divided by government, you can see that what I thought might happen is that we would test in general back to the Trump election levels, and you can see here this is the big gap going back to November the 5th and 6th. This is when Trump was elected, and there was a gap up. So we're seeing here ITOT is essentially the US stock market, so it's the totality of all the different stock indices and the stocks. And we can see here that that has been in a range, but essentially now in the last 4 or 5 days, it came back down to test that and essentially sort of signaling to the Trump administration, like, okay, are we going to get deregulation? Are the tax cuts on corporations going to be extended? Are we getting a tariff? We need some clarity on tariffs. And we're not getting that. And that's why we've seen the stocks basically underperform the bonds in the last 4 or 5 days. And we're also seeing that if you look at something like SPY TLT, that also has come in, you can see here, to fill the gap. But I think that's enough for the time being. And in fact, on Friday, just going into the close, we saw a crazy ramp up in the last 45 minutes of Friday. Now, a lot of people are saying that was month-end flows. I've been doing some research over the weekend. It was the end of February, so there was a lot of month-end flows to be bought. I saw a number of $13 billion being bought by pension funds. There was a short squeeze. Can this last? Maybe, maybe not. And it's important to realize that just like an hour before the close on Friday, that the stock market actually was at its year low. The stock market was at its year low at about 3 p.m. on Friday. So yes, we did get a 100-point rally in 45 minutes at the end of close. And we do have a bit of a risk on sentiment sort of globally, especially in Europe this morning. But let's just not keep in mind, let's keep in mind some of the bigger picture stuff. But just before I get off this chart here, just going back to ITOT government, I would say that something like about the 5.62 level you see around here, it's pretty important, because if we get a close below here, I think that could open the floodgates, and that could be a sentiment indicator of sort of negativity going forward. Now, as we say, we have bounced on some of these ratios, but going forward, definitely want to be keeping on the ITOT over government, my eyes on that 560, 561, 562 level. If it goes below here and closes below there, I think that's going to be indicative of potentially of a change in sentiment. So talking about the sentiment, where are we at? I mean, basically, if we look at something like the SPX, again, there's the election gap, which I had up here, which is, again, going back to the 5th and 6th of November here. We closed just at that level, and then we've bounced. Again, on Friday, we had that vicious bounce at the end. So at this point, is it over? Is this now we could all relax and say, well, that was a little bit of a sell-off, a bit of a sort of a finger wagging, pointing at the Trump administration that they need to get their act together, and we now go and test new highs. It's possible. But at this point, let's just have a look at some of the averages, like the simple moving average. So we're below the 100 moving average. If we get a close into this election gap, and even more so, if we fill the gap and go down to the 200-day simple moving average, that would be pretty bearish. But at this point, we haven't closed really deeply into the gap, and we certainly haven't tested the 200-day SMA here. So at this point, you've got to say that overall, we've had what I would say an increased probability of a growth slowdown. So an increased probability of a slowdown in the real economy. But that doesn't mean that we've actually had a slowdown in the real economy, and that's not equal to a recession. So I think at this point, the market has moved the probability. It's kind of repriced everything to include the possibility of a higher probability of a growth slowdown. And we've seen that, for example, in the SOFR curve, in the Fed funds futures, and pricing for what the Fed's going to do. And we've also seen it, as we say now, in some of these sort of ratios between equities and bonds. We've seen the outperformance of bonds compared to stocks, and in the outright price of stocks, we've seen it. If we also look at the NDX, exactly the same thing here in the NASDAQ cash index, going down to that, more or less down to the election levels and then bouncing. But the point is here is that We need data. We absolutely need data here. So, well, and this week we're going to start getting some survey data. We're going to get the ISM manufacturing today. We'll get the services ISM. We're going to get the ADP private payrolls, which is a bit of a weird number on Wednesday. And of course, we'll get non-farm payrolls on Friday. But talking about these payroll numbers, it's probably that's going to be for January numbers. So it's probably going to be too early at this point, really, to get a sense of any effects of the DOGE cuts, the Department of Government Efficiency. You know, a lot of the government workers who apparently are being fired. It's too early, too early to have that information about a potential recession. Now, last week, of course, we did get a little bit of a spike, 10, 20,000 extra initial jobless claims. Some people are saying that actually that was irrelevant. It's just seasonal. It wasn't in Washington. Other people are saying, aha, you see, everything's slowing down. So at this point, the jury is out. And a lot of the negativity, actually, in my opinion, hasn't been based on hard data. It's been based more on the surveys, and so I think, things like PMIs and whatnot, okay, it's interesting. And for sure, often they're a leading indicator, but we need to see hard data. So as long as we, stay above these 200-day moving averages, and as long as we're finding support at this sort of pre-election level, I think at this point, it's a little too early to be selling the SPY or the ES. Maybe it's potentially more of a sort of a selling calls kind of situation. Why do I say that? I say that because I also don't know that the conditions are in place for us to be ripping to new highs. Do I see as range trading? Absolutely. So I think, the key level in the SPX, for example, is probably still the 58.65, which is basically this level here. And if we go below that, it could be something like 57, sort of 60-ish, which, something around about here. So these are the levels. If it breaks, the 58.65 and goes down to 57.60, for sure, this is looking negative. Now, do I see it testing new highs or even up to 6,000 on the short term? Yeah, I think it's quite possible that going into non-farm payrolls, on the back of this positive sentiment in Europe, we go up on the SPX up to 6,000. But can it go further? I doubt it. We're going to have to get more sort of positive information, because at the end of the day, and we still had Besant talking over the weekend, he wants the 10-year yield down. He and Trump want the 10-year yield down. And they're saying, oh, we're going to, cut all of these workers and cut spending. If you cut workers, you cause more unemployment. If you cut spending, that is anti-growth. So it seems to me that, we know that Trump is sort of acting in with a certain amount of chaos, but the reality is that it's a pretty clear message, which is not being contradicted by Trump. The clear message from people like Navarro, the trade commissioner, and Besant, the Secretary of the Treasury, is that they want to cut the deficit. They want to cut the deficit. They want the 10-year yields down. They want the price of energy down. And they're very, very happy to cause a bit of unemployment and sort of to cut the fat. So all of that to me is pointing to the potential for the real economy in the US to slow down. Maybe not today, maybe not next week, but it's something we could start to see, let's say, in the second quarter. So, maybe later this month, April, May. And at that point, I think it might be time to really start thinking about a bit more of a sell-off in the stock market, because what's going to happen is that if we start seeing some of these sort of indicators and hard data in the real economy, that will start to get the attention of the financial markets. The financial markets don't like the stock price going down. They could start cutting off even more workers, and that could cause a sort of a snowball effect. And that's when we could actually, I think, retest a lot lower in the stock. So at this point, my personal thinking is maybe selling calls, up at 6,000, or maybe even a bit higher on the stocks in the shorter term. And in the longer term, I think you want to be selling rallies. That's my personal view. You want to be selling rallies. We have a fib situation here. Now, if we look at the fib, for example, here on the SPX, you can see that at this point, we'll have to see this morning, I'll put it on the ES futures. You can see here, we're just on this fib retracement, just here back to the 100-day moving average, which is about the 38% fib retracement. At this point, we haven't even done a 50% fib retracement. So that's the first hurdle for the bulls. They have to get above this from this impulse down here. Basically from the 19th of February, they have to get above the 50% fib retracement there, and then the 61.8 fib retracement. At that point, you could say, well, hey, maybe we're going to retest the highs and we're bullish. But until and unless we get there, I think you're still selling significant rallies. And there are going to be short squeezes. There definitely are going to be kind of short squeezes. Um, as I say, at this point, the European stocks are looking quite strong. What was interesting is that we did have a breakdown in the in the Nikkei. Actually, before we get across there, let's just look at the mags, and you can see here that the same similar kind of situation with the Mag 7 sort of index here that they got to the pre-election level. So everything going in the same direction there, and that bounced. We had also in the equal weight RSP that also bounced as well. So everything sort of having a happy little bounce, a reactive bounce. Let's see how it plays out. But just looking over in Asia, I just wanted to look here at the Nikkei. Excuse me. Pretty interesting with the stronger yen that actually came out of the trade range. It's subsequently bounced a little bit on the positive sentiment today. Got to its quite key levels here at about 37,750. Let's see if that goes back in the trade range, and this was just sort of like poking its head below, or whether it fails here, and that would indicate that that would be a risk off. So that's just an interesting one to be looking at. Just in terms of other stuff, let's look at some of the bonds, and what we've been seeing here is that there was pretty strong price action or last week in the bonds. So I'm going to go on to the yield charts here. So if you look here on the 2-year yield, you see the 2-year yield did move down substantially, but again, it came across resistance. And we know, if we look at the Fed, we can see what's priced into the Fed now, that there was some repricing basically on this. And again, what I want to say is that this was in my view anyway, not so much evidence of a growth slowdown, but the scare, the potential, the probabilities needed to be repriced. So what we can see here is a 15-minute chart for the December pricing. So this is the number of basis points which are priced in, estimated by the market for the Fed. And what we could all observe here is that if we go back, we go back, what's that, sort of like 8, 9, 10 days, the market was only pricing at about 1.5 cuts, so about 35 basis points. And what we can observe is that, because of some of that initial jobless claims, some of the Trump confusion, some of the talk coming out of the White House about this desire to not to cause a recession, but to basically cut jobs, cut spending, reduce the deficit. All of this stuff, as I said before, is anti-growth, and the market kind of got the message and went from 1.5 cuts, 35 basis points of cuts, until about 70. So about at the maximum here, 35 basis points of extra cuts. So it's another 1.5 were priced in. So at this point here, we're pricing in as we speak on Monday morning about 65 basis points. So that's 2 cuts, about 2.5 cuts are priced in. So substantially more dovish. But where actually we got a lot of the real kind of price action, so to speak, if we look at the bonds. So we look at the 2-year yields. For sure, they came down last week. But if you actually look at the 5-year, came down a lot more. And if you look at the 10-year and the 30-year, not quite as much. So it's really the 5-year and the 10-year here, which saw the most substantial moves in the yields. And I wonder if we could see that. So I'm just going to throw up a chart here from Bloomberg. Give me a second here. Hopefully this won't take more than a moment. Yeah, so what I want to look at here is just the curve. So US curve, I think this is the one. Right, so this is the US curve, and you can see here all the tenors from 1 month going all the way out to 30-year. So let's go back a week. So what I want to do is to compare, and you can just see where this moved. Yeah, so what you can see here is that the 2-year, like the very front of the curve, so you see the 6 months and 1 year. So there was some repricing for the Fed, which we just saw. So the Fed definitely repriced, but really where the significant pricing is, also on the SOFR curve, it's not for 2 or 3 or 4 months. It's really from much further out. And in terms of the longer tenors, we can see, for example, the 5-year here moved down the most, more than the 7, more than the 10, more than the 20 and the 30, and actually more than the 2. So really the 5-year, and you could say maybe the 7-year, that's where all of the movement was. So what is that telling us? That is telling us that, yep, it's telling us a few things. That for sure, the market believes that the chances of the Fed cutting a little more than had been priced in has increased, as we saw, but not massively so. Really, what it means when you see this, the 5 and the 7 and the 10-year, the belly of the curve going down pretty hard in the yields, is a market which is pricing in an economic slowdown, less growth, and ultimately maybe even less inflation. But the inflation would come from a slowdown in growth. So that's something like a demand slowdown. rather than a change in supply. So that's kind of not, that's a bit of a negative kind of situation here. And we also see that if we look at things like that's general sentiment here. If we look at things like, for example, the term premium, and we can see here that the term premium, this is year to date. So if we could see the beginning of the year, which is, what, a couple of months ago, the term premium, which is the extra yield which investors demand to hold longer term bonds based on fears about policy uncertainty and inflation risk. And economic growth, that was at plus 80 basis points. And we can see that, even in the last 3 or 4 days, that's come down pretty aggressively, and it's now at 60 basis points. So the term premiums come down quite a lot. And we can also see, for example, the real yield. So that's the yield after inflation. I mean, year to date, again, we can see that that's at the beginning of the year, that was basically up at, where are we? About 55 or so. And you can see that that's come all the way down to about 51 or so. So the point is here is that the real yields have, oh, sorry, I beg your pardon, I was looking at the wrong one. Yeah, 2.3, that my mistake. I wasn't focused there. So at the beginning of the year, about 2.3% real yield, very healthy, and it's come down to about 1.85%, as you can see in the last 3 or 4, 5 weeks. So what it's telling us, the bond market is saying that, it believes that inflation is still a bit sticky, but it could come down because of a growth slowdown. And that's been reflected in term premium coming down, real yields coming down, of course the nominal yields also coming down on the US curve. So what does that all mean? That all means that that's where we're at. But I think that we've got to a point there that's probably going to stabilize now, because we've come quite a long way in the last few weeks. Now, what we now have to see, and what we're going to start getting this week, as I said, is some survey data. We get the ISMs, the PMIs, and we'll also get some real data. So finally, guys, I just want to look at some positioning and a little bit. Let's look at just a little bit what's going on in FX. So if we look at the positioning, kind of interesting here. If we look at just as, for example, something like oil, we see that oil, if you look at the WTI, it had a huge change of 35,000 contracts negative. This is one of the biggest change ever. So oil is very, very oversold at this point. The percent change minus 35. So you could see here on the commitment of traders minus 35%. That's also for Brent, down 44,000 contracts. So basically oil, these numbers were released on Friday. Traders have dumped all their oil. So interesting, oil is sort of in the doghouse at the moment, but it is pretty oversold. And we can see the positioning now is getting to a point where it's relatively clean. What is also interesting is that gold, finally, there was a bit of profit taking in gold and silver. So you see gold down 7,000 contracts on the futures, silver down 6,000 contracts. These are the futures, the commitment of traders on the futures market. So down quite a lot. And we can see that a little bit in graphic form. I just want to show you another way of looking at that is just from a different source here. So if you look here just at what's stretched, you can see here that something like oil now, it's pretty neutral. You can see here that it was sold off a little bit more. So oil at this point now is pretty neutral. If you're feeling like getting long, this is nice and clean. Gold is still very, very stretched, but as I say, people have started to take a little bit of profits, but gold is still pretty stretched. What I would also look at here just is in terms of the FX positioning, which is kind of interesting as well. You can see here that the New Zealand dollar is extremely oversold. We can see CAD is very, very oversold. Swiss franc is pretty stretched short, but really the ones here is CAD and the New Zealand dollar. And for me, this is kind of interesting. On the other hand, of course, you see that the Japanese yen moved even into more overbought kind of territory. And this is interesting if we just look at a couple of these charts, because tomorrow, in theory, is the day when the tariffs go on to an extra 10% on China, the 25% on Canada, and on Mexico. And interesting for me, I've just been looking at the Canadian, the chart here, is that as we see, the Canadian dollar is extremely oversold. If Trump at the last minute which could be like late this afternoon or overnight, God knows, decides not to put the full 25% or no tariffs, or there's a deal or only maybe 5% tariffs, or some people are saying that Canada and Mexico will agree to put the same tariffs on China as the US is doing, some kind of compromise. I do believe here that there's space for the USD, the US dollar to come off, to weaken against the Canadian dollar, because it's come a long way and we're getting at pretty interesting sort of resistance levels here at 144.6. On the other hand, if Trump goes full tariff and puts universal 25% tariffs, no exemptions for oil, can USD CAD go higher? For sure. I'm not sure it's going to reach all the way up 147, but I think another 100 pips or so, another percent is absolutely possible. Interesting to see what happens with the Mexican peso as well. And of course, the other one is China, because we see here the renminbi, the offshore here, the CNH. The fact that on the tariffs, it did go up to 7.36, which is a key level. It's like a triple top. If you go back here, 7.36, very, very big level there. You see the big triple top there. I'm not sure the Chinese authorities want that to weaken. But for sure, if Trump does go ahead with an extra 10%, and there are tariffs put on Chinese incoming products via Canada and Mexico, I do believe that there is space here for the US dollar to strengthen against the yuan, maybe all the way up to test the 7.36 level again. But that's kind of another story. Okay, guys, running out of a bit of time here. Don't want to go too long. What I would just say for gold had a little bit of a sell-off, but I think it's more of a consolidation. I have some charts. You see here gold, it did get done. Personally, I think this is the level. I'm loving this level here, 27.95 here, 27.90, something like that on the spot gold. Now, can it bounce here? Absolutely. Yeah, for sure. I mean, if you draw a fib, maybe the shorter term fib, something like here, then suddenly this is like the 50% fib bounce. So if you draw a fib from the 27th of January kind of impulse, can you argue technically that this is a justified bounce? Yes, we shall see. On the other hand, I think it is due for, a relative correction. And I think this on the bigger fib level drawn, from this impulse from the 14th of November is a better one, 2790 or 2800. I think that is definitely a good one. Just finally, and just actually, I will show you, because I did have a kind of a nice chart here, and I do hate to waste my charts. If you, oh, sorry, I think that's the wrong one. Excuse me, guys, got a lot of stuff up this morning. Oh yeah, there's, just by the way, this is nice just on the trends in terms of the FX. We can see here that the Japanese yen still quite strong trend. Interesting that the Australian dollar and New Zealand dollar and CAD to a degree, but not really enjoying the sort of the positive vibes overnight. Still pretty worried about potential tariffs of China and global trade. And also in the case of Australia, let's keep in mind, don't want to overemphasize this, but we've started to have the Chinese doing military activities in warships off the southwest coast of Australia and the eastern coast of Australia, which is quite unusual, quite aggressive. So I just wonder if there's a little bit of geopolitical risk being priced into the Aussie dollar here, because the Aussie dollar and the New Zealand dollar are not really benefiting that much overnight from the positive vibes. So you see that those currencies still under pressure. As we see, that could change if there's no tariffs imposed on Canada today. But gold is still doing pretty well. But gold, as you see here, if we go back on the trend, you can see that gold had been in a crazy positive trend, on this particular indicator, 10s, 11s, now sort of weakening a little bit. So still a positive trend, but that trend is definitely weakening. We can also see that the Japanese trend is still positive, but weakening a little bit. And we can see the US dollar is fairly neutral. But what I want to say about gold medium term is that if you look here, this is just a chart from Bloomberg of the World Reserve, the IMF World Reserves of gold holdings. We can see that the total reserves here are actually going up. So reserve managers at all the global central banks, they are definitely buying more gold. As you can see, it's been in an uptrend now for 10 years, and especially ramping up after the Ukraine invasion. And if you also see here, this is the reserve managers, as I put in the headline here, is slashing dollar holdings. So you can see here, so that the white line is US dollar role in global FX reserves. This data is going back a few months, but you get the picture that slowly but surely, and especially in the last few years, the percentage of global reserves held in the US dollar is slowly going down. And so the point is here that there definitely is some kind of structural change, which is relatively slow, but it's persistent, that global reserve managers, central banks globally, are definitely shifting a little bit out of US dollars and US dollar assets and US bonds, and a little bit into other reserve currencies, but specifically gold. And gold is a relatively small market, so these constant demands are definitely sort of it's kind of bullish. So the thing is in gold is just to look for pick your poison. What level is a good retracement level? Personally, as I say, I'm looking for the 2790 level. We'll see if we get it. I'll leave it there, guys. Just finally, keep your eye on volatility. Volatility is down. No surprises. Vol did spike up to over 20 as we look on the VIX, just as we're trading this morning. Let's have a look. It's 8 o'clock now. You see it's down 19.5. So again, for me, really the key level here is more like 20 and a half, 21 or so. That's really when things get persistent and volatility has pushed down. But what is interesting is just this idea that volatility, it's not down at 12 or 13, it's definitely a little bit high. And if you consider that, to get the implied average daily volatility on ES or SPY, you have to divide the number by 16, just mathematically. So we're still pricing in, at least like 1.25% of volatility daily moves every day. So let's just keep that in mind. And just finally, I just want to look at that Friday afternoon ramp, which you can see, where was it? Where was that ramp? So you had that crazy ramp here. You had like 100 points here in Friday afternoon from about 3 to 4 o'clock. But just keep in mind, guys, that as I said earlier in this sort of overview, that just a few minutes before, at 3 p.m., equities were down at their lows for the year. See this down here. So let's just keep an eye on things. And see how we go and see if there's any breakdown in the positive vibes. Okay, it's gone a little bit too long, but I'd like on the Monday, there's a lot going on, just to have a bit of an overview. I did want to talk about commodities. They seem, if you look at any of the broad index for commodities, to be fairly flat, nothing really particularly breaking up. Definitely gold is outperforming all of those commodities. So I think is that also signaling a slowdown in global growth and maybe less inflationary forces going ahead? We'll keep on talking about that. Okay, I'll leave it there. Have a great week. Thank you.